Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So how much is 1 trillion? We hear the number thrown around, but can we even really wrap our head around what it means? What exactly is a trillion? Well, here are a few factoids that will help you put 1 trillion in perspective. So there are 1 million seconds in 11.5 days. 1 trillion seconds is about 32,000 years. If you could say one number every second, it would take about 11.5 million days to count to a trillion. If you had spent $1 million every day since the birth of Jesus Christ, you still wouldn't have spent $1 trillion. If you line up dollar bills end to end, you could go to the moon and back 203 times with $1 trillion, and you could wrap them around the earth about 3,893 times. If you stacked up $1 trillion bills, the dollar tower would rise to 67,866 miles. If a cup of coffee cost you $3, it could buy 333 billion cups of coffee with $1 trillion. If you had $1 trillion, you could give every person on earth approximately $125. And 1 trillion grains of rice would weigh about 20,000 metric tons. So that's $1 trillion. And the national debt is nearly 40 times bigger than that. As of August 17th, the national debt was on the verge of eclipsing the $40 trillion mark. In fact, we'll probably cross 40 trillion before the end of the week. As of August 17th, we were at 39 trillion. 986,657,878,071.92 to be exact. I knew I wasn't going to be able to read that big long number right. So if you were to ask me, Mike, what is the most significant thing in the economy that most people seem relatively unconcerned about? I would say this trillions and trillions of dollars in debt. But it's not just the national debt. There's $5.17 trillion in consumer debt in the U.S. alone. And then there's the corporate debt, which is also at record levels. I call it the debt black hole. Greg Weldon actually came up with the term, and I've used it. I want to make this term go viral. So if you're ever talking about the debt, use hashtag debt black hole. Because it is the perfect description of the debt situation. A black hole has such a strong gravitational pull that it literally warps everything around it. Its gravity is so strong it sucks light into it, thus the term black hole. And that's what all of this debt is doing to the economy. It's warping the economy. It's impacting everything around it in subtle ways. It's why the Fed keeps talking about slaying inflation, but is still running historically loose monetary policy. It's why they talk a lot about raising interest rates, but they're not raising interest rates. It's why I keep insisting the central bank isn't likely to raise rates and will probably lower them again sooner rather than later. It's why the bond market is tanking and why we're heading, or part of the reason we're heading into a secular bear market in bonds. It's one of the reasons that central banks are buying so much gold. So today I want to talk a little bit about the debt situation, but I want to focus primarily on the private credit market. This is actually a small segment of this debt black hole, but it's a sector that could collapse and trigger bigger problems in the broader economy. But before we get into all of that, I do want to, as always, thank you so much for taking a little bit of time out of your day to listen to the Midweek Memo podcast. I very much appreciate it. I say this every week, but there are so many things out there vying for your attention, and I appreciate the fact that you trust a little bit of your time to me every day, and I do my best to give you 30 minutes of good, solid content that will hopefully give you something that maybe you're not getting out there from the mainstream financial gurus who are out there on Fox Business or CNBC or whatever. Now, We don't charge you anything for this greatness, right? But you can't help us out. And I'd really appreciate it if you would just go to wherever you consume your podcasts and write a little review. Hopefully a good review. Give us those thumbs up, give us those stars, and that will help trigger the algorithms and help grow the show. The other thing that you can do is share these episodes. I can't tell you how much it means when the episodes get shared, because it boosts them and more people are exposed to what we're doing here. And, obviously I want to grow the show. So if you can help with that, I would say thank you again. But most importantly, just thank you so much for being here and listening to the show. Okay, before I delve into the private credit market, I do want to quickly highlight the July Treasury statement. That's where the Treasury Department tells us how much money the government spent, how much money it brought in, how much the deficit is. That came out last week or a week before last, not too long ago. And, without the tariff revenue to paper over all of the excessive spending, the U.S. ran the biggest monthly budget deficit in 5 years last month. The Trump administration spent $432.31 billion more than it took in July, a $432 billion budget deficit. It was the highest monthly budget shortfall since March 2021, which of course was in the midst of the COVID stimulus era. And this was actually the third largest monthly budget deficit on record. Now, little caveat to that, with August beginning on a weekend, there were some calendar adjustments of around $99 billion as August benefits had to be paid out in July. So it kind of got, some of that spending for this month got backed into July. So ostensibly, the August deficit will be a little bit lower than it might have been. But it inflated July's outlays. However, even adjusting for these calendar shifts, the July deficit was still $333 billion. That was up 18% from the prior year. So maybe, talking about the fact that it was the biggest deficit in 5 years, maybe that's overstating things a little bit, but still $333 billion deficit in a single month. And I think even more significant than that is the fact that the July shortfall pushed the 2026 budget deficit to $1.8 trillion with 2 months remaining in the fiscal year. Keep in mind, the fiscal year begins in October, it ends in September. So we still have August and September data to add to that 1.8 trillion. And even so, the deficit right now is larger than it was last year for the entirety of the year. And we're on track to eclipse $2 trillion for the federal budget deficit. Now, let's put this into a little bit of context. Keep in mind that the federal government ran $1 trillion deficits for the first time during the Obama administration. That was during the Great Recession. And Obama ran 3 or 4 years of $1 trillion plus deficits. I think it was 3. But again, during a huge economic downturn where federal revenue was significantly constricted and the government was spending a lot of money on stimulus. That was $1 trillion. We're at $2 trillion today, right? We're seeing $2 trillion deficits with the economy supposedly expanding. I mean, if you ask some people, the economy's doing great, and yet we're still running these massive budget deficits. Now, there are a couple of reasons that we're seeing these big deficits right now. For one thing, the government is refunding tariffs at a brisk clip. Keep in mind that the Supreme Court ruled that the tariffs imposed unilaterally by the Trump administration were unconstitutional. And so the government refunded $33.38 billion in tariffs in July alone. And that sent tariff revenue negative by $8.55 billion last month. Now, a few months ago, we were seeing $40 billion in tariff revenue adding to the tax receipts. And that was helping, again, cover the spending. That's gone. And now we're having to pay those tariffs back. And we're seeing a big dip in federal receipts. The reality is the tariff revenue papered over the bigger problem. Your government can't stop spending money. The Trump administration blew through $766.31 billion last month. Think about that. $766 billion spent in 1 month. That was a 22% increase over July 2025 spending. Now, when we factor out the $99 billion for calendar adjustments, the federal government still spent $677.31 billion. That's well over $500 billion in a single month. And this happens month after month after month. And of course, borrowing money to cover deficits comes at a cost, right? Every time we see a budget deficit, the government has to borrow money. So the government ostensibly had to borrow, over $700 billion more to cover that the July shortfall. So interest expense has grown into the second largest spending category in the federal budget. The only thing that the federal government spends more money on than interest expense is Social Security. In other words, we're spending more money just paying interest on the debt than we are on national defense or on Medicare. So in July, the Treasury forked out $117.57 billion just in interest payments. And that was actually down slightly from the record of $185 billion that the administration had to pay out for interest expense in June. July interest payments pushed the total interest expense for the year to $1.17 trillion. And that, again, is through the first 10 months of fiscal 2026. We're up 15.5% compared to the same period in fiscal 2025. And last year was a significant increase over the year before that. So we're seeing almost an exponential increase in interest expense. And of course, this is creating this nasty negative feedback loop. As interest expense grows, the deficit gets bigger. That means more borrowing at higher interest rates, and that's adding to the interest expense. And yet we have all of these people out there that really believe the Fed is going to successfully raise rates in this environment. But Mike, the Fed is independent, you might be thinking. The central bankers don't consider these fiscal issues when they're setting monetary policy. They're just focused on interest rates. Okay. And if you really, really believe that, I've got some beachfront property in Phoenix that I'll be happy to sell you. So as I've already mentioned, the national debt is just one leg of a massive debt trifecta, right? We have the national debt, government debt, then we have the consumer debt, which I've already mentioned, and we have corporate debt. As of quarter one, total non-financial corporate debt stood at $14.45 trillion. $14.45 trillion in corporate debt outstanding. When I say non-financial, I mean these are companies that aren't banks or involved in the financial system. And this is according to Federal Reserve data. The corporate debt is up about 5% from the previous year. So again, we're seeing this corporate debt bubble getting bigger and bigger. The debt black hole is sucking things into it, and it is expanding. So what I want to do today is focus on a small but significant portion of that corporate debt, and that's the private credit market, because it is under growing stress. And it's the kind of thing that could blow up and spread like a contagion into the broader financial markets. So according to the Wall Street Journal, and this was analysis that they did over there, the private credit market is under increasing stress, with default rates spiking and internal reviews of loan health pointing to tougher times. So, private loans total around $1.4 trillion. You'll keep in mind that the total corporate debt is over $14 trillion. So that $1.4 trillion represents roughly 10% of debt held by non-financial corporations in the United States. Again, this is based on Federal Reserve data. Non-bank lenders make up this private credit market. So that's what we're talking about here. We're talking about banks or financial institutions. We're talking about non-bank lenders. These are primarily entities that raise capital via institutional investors, pension funds, endowments, wealthy individuals, people who want to invest in debt, right? These folks fund these funds. They bring money into these funds, and then the funds loan money directly to companies or individual projects. The private loan market offers companies and entrepreneurs a source of non-bank financing that is often more flexible and a little bit more lax in underwriting. So, maybe you can't get a Bank of America loan, but maybe some of these private lenders would be happy to invest in your project. Now, the private credit market is an interesting example of incentives, right? This private credit market actually grew significantly in size and importance after the 2008 financial crisis, because after that, banks were facing stricter capital and lending regulations. And so the private financing funds stepped in to fill the financing gap. So to put it simply, banks were less inclined to lend to risky clients. And so the private credit market grew because there was a need for this type of financing. It's a prime example of how regulation incentivizes movements of capital into different places. So this private credit market has grown directly due to government steps taken after the 2008 financial markets. Meanwhile, investors are pouring money into these private credit funds because they're hoping for bigger returns, right? They can get better returns because they're taking on more risk than they would get buying traditional bonds. Everybody is chasing yield right now. And this is what happens when you have a world where the money is broken. When you have broken money, it incentivizes crazy things. I did an article last week about the fact that a lot of Gen Z has now taken sports betting as part of their investment strategy. I'm not kidding. They really look at sports betting because you can make money faster, more money more quickly than you can trying to invest in the markets. Certainly a lot more than, just sticking money in the bank. You can't do that because you can't keep up with inflation. So broken money leads to riskier behaviors in the markets, and the private credit market is kind of part of that big bubble. So private loans still make up a relatively small share of the total corporate debt, right? About 10%. A collapse in the market, though, could easily spread into the broader credit markets and lead to a financial crisis. And we've seen this happen before. The dynamics are not unlike the subprime mortgage market in 2005 and 2006, 2007. At the height of the housing bubble, subprime only accounted for 13 to 15% of all mortgages. Nevertheless, the collapse of subprime ended up taking the whole housing market down with it and then pulled the economy into the Great Recession. So these small sectors can have an outsourced size if they collapse. It's contagion, right? Things spread. Panic spreads quickly. Now, up until recently, private credit funds were one of the quote-unquote hottest flavors on Wall Street. That was a term that was used in the Wall Street Journal article. And this was basically due to their big returns, right? However, big returns generally involve big risk. And last year, that risk caught up with the industry and things started to turn sour. There were several high-profile defaults. There were some allegations of fraud in a couple of funds, along with the large number of loans that were made to software companies that suddenly seemed highly at risk for disruption due to AI. So in response, people see these problems, the risk gets a little bit too big for people to be comfortable with, so investors began asking for their money back. So that's a big problem, right? You've got this fund that is trying to loan money, and people are saying, I want my money back, right? So facing record withdrawal requests, some funds actually restricted redemptions and limited withdrawals. Now, if you talk to fund managers and people that are out there, just kind of your mainstream thinkers, they're going to tell you that any problems in private credit were overhyped. They insist that everything is fine. However, there's now a new source of stress. A review of quarterly reports issued by the biggest players in the private credit market, analyzed again by the Wall Street Journal, shows, quote, loan health and investor returns are worsening. And so according to reporting by the journal, private credit funds overseen by Ares Management, Blackstone, Blue Owl Capital, and Golub Capital reported loan defaults hitting the highest level since 2021, which was a year into the economic chaos caused by the pandemic. This is an interesting trend I see a lot in the economic data. We're seeing a lot of things. This is the worst it's been since the pandemic. It's the worst it's been since the pandemic. That was during the pandemic, right? What's going on now? Supposedly nothing. And yet we're having these problems, right? So as one example, the default rate at Blue Owl's fund hit 2.8% in Q2. Now, that doesn't sound like that big a deal, but it's the highest level in at least 5 years. And according to the Wall Street Journal, non-performing loans at other funds also hit 5-year highs, exceeding levels seen during the spike when the Federal Reserve was tightening monetary policy and raising interest rates in 2023. According to Fitch Ratings, U.S. private credit default rate stood at 6% at the end of May. Now, again, 6% doesn't sound that high, but it's pretty high for a default rate. And really, all you need is one big default, and that's when the whole bottom can fall out. According to the Wall Street Journal, defaults currently appear to be concentrated in the healthcare sector and businesses most heavily impacted by rising oil prices. For instance, Loparex, a firm that makes plastic film, recently defaulted on its private loan. Fitch reported 14 defaults in May alone. Now, so far, these defaults have been concentrated in healthcare, industrial and manufacturing, and the business service sectors. But there are worries that the default bug could begin to spread into the software sector. And again, we're seeing a lot of disruption in the software sector because of AI. In many private credit funds, 20% or more of the outstanding debt is owed by software companies. So if we start to see extreme stress in this sector, then it's, again, the thing that could begin to tip the entire house of cards. It's like bumping the table, right? It doesn't take much. Private credit funds also report an increase in the number of companies on their watch list of companies that are showing signs of trouble. So this is kind of like the waiting room for defaults, right? Not looking good for these companies. And as the Wall Street Journal reports, private investment firms can't afford any more write-downs after a rough 2025. So now we're talking about the entities, the companies that are making these loans. They can't afford any more write-downs, any more defaults, because as the journal reports, the performance of their funds is already suffering, and their stock prices have only just started to recover after sharp sell-offs that began last year. Now, while default rates are rising, they do remain below levels seen during the extreme high stress periods, such as the pandemic and the oil price crash in 2015. And the Wall Street Journal noted that losses could abate if interest rates decline and economic activity remains robust without pushing inflation higher. That's a lot of ifs, right? And, let's just look at inflation. While the CPI has cooled, that's not the entire story. You also have to look at the money supply. You have to look at the Fed balance sheet. And when you look at these other dynamics, we find that these other data points point to an increase in inflation. And I will link to an article in the show notes page that gives not only an overview of the July CPI, but these other factors, a more complete inflation story, as you will. But even if you just look at the CPI and say, well, Mike, it's moderating, it's still well above the 2% target, right? That means the Fed really needs to keep interest rates higher for longer if they really are serious about, that 2%. So if that's true, there really shouldn't be much hope for rate relief as long as the economy keeps stumbling along as it is, and that CPI remains stubbornly above the mythical target. And there are a lot of people who still think, we're going to get rate increases. Well, I'll tell you what, if we do get a rate increase, it's going to create even more stress in this private credit market, which is already on shaky ground. And again, it's just going to take a table bump, and the house of cards is going to fall down. Now, fund managers, as I've already mentioned, they insist everything is fine. And at this point, Wall Street seems to be buying the narrative. If you listen to the mainstream reporting on this, they'll say, yeah, there's some problems, but probably good, probably no problem, right? They'll tell you that private credit investment has rebounded modestly over the last few months. But again, additional defaults, even one big default could tip the boat. And the Wall Street Journal noted that if returns stay stuck or drop, more investors may walk away. Quote, fewer investors mean it would be harder for fund managers to raise money, shrinking the supply of capital to refinance existing corporate loans when they come due. So again, it doesn't take much. These kinds of things, they happen slowly and then all at once. So despite assurances from fund managers and pundits, warning signs are flashing in the private credit market. It faces a double whammy of contracting liquidity and deteriorating loan portfolios. This is a recipe for a private credit meltdown, which again could spread into the broader financial markets. And don't forget, everything was fine in subprime in 2006, 2007, until it wasn't. You know, when you think back to those days, everybody was saying everything was fine, even in early 2008. Of course, it wasn't, and things aren't fine now. But they look fine because people are good at sweeping things under the rug and kind of turning a blind eye until it all unravels. And then it happens quick. So you have to be prepared beforehand. I really like that saying, you know, things happen slowly and then all at once. Things are bubbling under the surface that people just don't notice because we're focused on other things. Right now, the markets are completely dominated by whatever headline we get about the war in Iran. There's other stuff going on. Don't forget to watch the bigger picture, right? So gold and silver have rallied over the last few weeks. Gold is trading above $4,400 an ounce again. Silver is solidly above $65. This could be the beginning of the next leg up. Now, of course, you never know. The next war headline could slam both gold and silver lower again, right? Worries about the Strait, those types of things. But this also could be the beginning of the next leg up. And regardless, it shows me that there's still a lot of bullish sentiment in the gold and silver market. It's being held down by the war worries. It's being held down by worries about interest rates higher for longer. But as we've talked about, that's the whole theme of this show. We're talking about the debt because it explains why the Federal Reserve is handcuffed, why it is having such a difficult time of doing what's necessary to slay inflation. It can't because we have a debt black hole. So I still think that you probably have some buying opportunity here before things really take off again. I'll tell you what, if the private credit market collapses or whatever bubble that ends up popping that takes this debt-riddled bubble economy down with it, whenever that happens, you're going to see gold take off, probably at even a more accelerated pace than we saw last year. So you want to have that insurance in place. You want to have your inflation hedge in place, right? You don't want to be scrambling at the last minute when everybody suddenly realizes, oh my gosh, this really is bad. So take a few minutes today, go to moneymetals.com, check out our specials. You'll find a bunch of great specials on both silver and gold. I want to particularly highlight today, we have First Mint Kilo Silver Bars for only $1.99 over spot price. This is a premium offering by First Majestic Silver, one of the largest primary silver producers in the world. They're beautiful silver bars, and $1.99 over spot, you can't beat it. And to boot, there is no quantity limit. So check that out. Again, just go to moneymetals.com. At the very top, you'll see our specials. There's a little flame there because the specials are awesome. Click on that, and you'll see those silver bars along with other specials that are there. But do it today because at some point, this is going to take off again. There is still plenty of bullish sentiment in the precious metals markets right now. Now, you know who has been taking advantage of the price dip over the last several months? Central banks. Central bank gold buying was one of the pillars supporting the gold bull market last year, and it has continued to bolster the market even as it faced significant headwinds due to expectations of higher interest rates over the last couple of months. But why are central banks piling into gold, even as they minimize their exposure to the dollar, right? This is part of the de-dollarization trade, or as some people have called it, the Sell America trade. Well, I think there are four key reasons. And I'm just going to go through them briefly. I wrote an article about this, and I'm going to link to it on the show notes page. And I'll go into a lot more depth about each of these four reasons, but I do want to highlight them here because I think they're important. Number one, geopolitical risk, right? We have wars, rumors of wars. You just don't know what's going to happen next. It's not just Iran in the Middle East. We also have the ongoing conflict between Russia and Ukraine that implicates other areas of Europe. There's some hot spots in Africa. There's a lot of geopolitical risk out there. Gold has historically been seen as a hedge for geopolitical risk. So that's one of the reasons. Number two, the weaponization of the dollar. And that goes hand in hand with the geopolitical risk. You'll recall that when the U.S. or when Russia invaded Ukraine, the U.S. and its Western allies aggressively sanctioned Russia. It even locked Russia out of the SWIFT system. It's effectively used the dollar as a foreign policy billy club. Other countries have taken notice of that. They've thought to themselves, look, if the U.S. can use the dollar to kind of force countries to do their will, maybe we shouldn't have so many dollars. We don't want to be under America's thumb. So let's get rid of the dollars. Let's hold gold. No counterparty risk. We've seen the importance of holding gold for Russia because their gold reserves have allowed their economy to continue limping along despite the strains of the war and of sanctions. So geopolitical risk leads to the weaponization of the dollar. De-dollarization is ongoing. Central banks are replacing dollars with gold. Number three, worries about the U.S.'s deteriorating fiscal situation. Basically what we're highlighting today, that national debt, $40 trillion, probably by the end of the week. Countries are looking at that and they're saying, should we really loan our drunk uncle any more money? He doesn't seem to know how to put the Visa card back in the wallet. So we're seeing this stress in the bond market. There's too much debt. Interest rates are rising. So this is another factor. You don't want to hold dollars. You want gold in this situation. And then number four, regime uncertainty. And that just means we don't have any idea what the current administration is going to do next. What's the tariff situation going to look like in a year? What's the war going to look like in a year? Whether you love Trump or hate Trump, you have to admit that he's not exactly predictable. And some people would say that's a feature, but in an economic context, it is definitely a bug, right? People want certainty. They want to know what things are going to be like in 3, 5, 10 years because, if you're going to start a big business, you're going to open a big manufacturing plant, you're looking ahead way into the future. You want to know that the regulatory environment is going to be similar to what it was, right? We don't have any certainty at all right now, and that makes people nervous. So they want to hold something that they know is going to be stable. They know there's no counterparty risk. They're holding gold. In an op-ed published by Reuters, financial journalist Jamie McGeever said that none of these events on their own would necessarily spark the current revival in gold. Quote, but throw them all together, and it's a pretty compelling checklist, especially for central banks, which had already started to ramp up their purchases in the second quarter after a lackluster first quarter. And McGeever is referring to the resurgence of central bank gold buying that we saw in the second quarter of this year. Facing price pressure in Q1, central bank purchases slowed a bit, but things started picking up in April. And central banks bought 289 tons of gold in the second quarter. That's nearly 5 times more than the Q1 total. If you go back over that list of things, those 4 things that I mentioned, there are also good reasons for you to pile up gold. It's not just for central banks. So today's the day. Call Money Metals, 800-800-1865. Talk to a Money Metals precious metal specialist. Ask them questions. Ask them how gold and silver can fit into your investment strategy. If you have questions, if you're confused about things, they can answer those questions for you. They can help you figure out how gold and silver can fit into your strategy and how you can best accumulate gold and silver in your portfolio. So make that call today, 800-800-1865. If you don't want to talk on the phone, go to moneymetals.com. You can chat online with the precious metal specialist. Or, if you want to just buy something, you want to take advantage of those specials. You want to buy some Canadian maple leafs. You can find them on the website. You can order online, pay online. We'll ship the metal right to you. And you'll have it right in your hot little hands very quickly. Or you also have the option of storing your metal in our state-of-the-art bullion depository in beautiful Eagle, Idaho, where I can assure you that there are ongoing and regular audits, unlike Fort Knox. So do it today. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up. Get yourself on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, make sure you tune in to our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. And thanks so much for listening to the show. I hope you have a fantastic rest of your week. And I'll be right back here behind the microphone again next Wednesday.